Thank you for joining us this evening. If you haven't met before, my name is Sean McKeel. I'm one of the co-founders of Blockmatics. We are partnering with Blockchain and Law, a new meetup, to host this event this evening. So thanks for coming out. Really appreciate it. Thanks for participating in the raffle earlier if you did. We'll get to that at some point later after the panel. I know you guys are eager to hear everybody. I just want to go over a couple announcements quickly before we start to bring the panelists up and begin. So as I mentioned, we're partnering with Blockchain and Law, a new meetup group. If you haven't joined, feel free to join them on Meetup to stay up to date on our latest events. This is part of a new monthly series that we'll be doing, where we're basically trying to get the top people in law and technology to come up here and talk about some of the issues and news in the space, basically. So if you're interested, please join us for the next one. If you're interested in speaking, feel free to reach out to us. We're always looking for qualified people to join us. And we're also live streaming tonight, so wave hello to everybody watching on the interwebs. Thanks for joining us online as well. Quickly about Blockmatics, we are a blockchain education company. We've been doing classes here in New York City for over a year now. Over 120 students have graduated our Business of Blockchains course, which is basically, it distills 6 months worth of independent research in about 6 hours. So it's kind of like a turbo learning session for those of you who know nothing about blockchain technology or know a little bit and really want to get started. We cover lots of different use cases and also how the technology works with no coding necessary. So don't be afraid if you're not a developer. And we're excited to announce our first class out of New York City, actually going to be happening October 14th. in Boston. So hello people from Boston, we're coming up to you. Very excited for our first class up there. And is that live, Solomon? That event page is up? Yep. That event page is up, so if you're in Boston or if you're visiting and you'd like to go check out our class there, feel free to sign up. And we'll be announcing an official date for our next meetup, the Blockchain and Law meetup, sometime in October, and also another Business of Blockchains here in New York. So if you're interested, we get to the top companies like Block Apps who are developing every day to come in and help show you some of the stuff as well. And then you get your name certified on the Ethereum blockchain and you're an official graduate. So talk to us after if you're interested in any of that. But no longer further ado to bring these guys up and introduce Greg first, and then who is our host for this evening, and then he'll introduce the panel. So Gregory J is our partner for the Blockchain and Law meetup. Yeah, thanks. Give it up for Greg. Also serves as counsel at Elixr 1, and yeah, he's going to be our host for this evening. So I'll pass it over to him.
Oh, thank you. Do I need to use the microphone?
Oh, no, sorry, actually.
I'll just project. Thank you, everybody, for being here. Why don't the panelists come up? I don't have to make it so dramatic.
Thank you.
Conor, I think
Oh.
yeah, well, there you go. So, welcome, everybody. Thank you for being here. Episode 1 of Blockchain and the Law. We'll be discussing cryptocurrencies, blockchain, their effect on the markets. And here we have some of the brightest minds in the legal game. Why don't you guys go ahead and introduce yourselves and we'll get right into it.
Josh Garcia, I'm an attorney at Cooley.
Conor O'Hanlon, I'm an attorney at Allen Overy.
Kevin Scanlan, partner at Kramer Levin.
Scannavino Lamb, partner at Scannavino Lamb.
So, as we all know, we've been watching the news. We've seen comments from Jamie Dimon, Ray Dalio, founder of Bridgewater Capital, biggest hedge fund in the world, Warren Buffett. They've all come out and had interesting comments about Bitcoin, ICOs, where we are in the market, potentially a bubble. And then at the same time, we have the founder and inventor of Ethereum, Vitalik Buterin, actually say that the majority of these ICOs are potentially scams. So the question I'd like to start with the panel is, where are we from a regulatory perspective? And where are we going? Conor, if you'd like to field it first.
I mean, I think it's interesting. It's very much an international problem, if you could call it that. I think maybe it's worth focusing on maybe some of the more recent developments in China, for example, the complete ban of cryptocurrency and the content exchanges. I think you've seen regulators across the globe come out with issuing statements saying what I think most competent lawyers already knew, which is many of these tokens may represent securities or financial instruments in the relevant jurisdiction. We've seen that most recently, I think, in Australia, also the UK, many other European jurisdictions. The SEC came out with their DAO report earlier in the summer. So I think it hasn't necessarily changed the game, but I think there have been a number of potential projects. Some have been, extremely transformative. I know Josh and Cooley have been working with Filecoin, which I think is one of the more exciting ventures. But there have been, and there continue to be, a lot of tokens that are being proposed that, frankly, are likely to be securities and regulated as such. And I think there's a difference there between the expectation and the reality. And I'm not sure that the market is necessarily caught up with that.
So with respect to Filecoin, so please correct me if I'm wrong, Josh, they raised about $250 million in a regulation D offering in about 48 hours?
It's never as short as the time suggests. Because those 48 hours, you take several months of, reaching out to investors and building hype and, building prototypes of product, developing white paper, etc. But yeah, I mean, when the sale actually started, they already had around 50 million, or I forget the number, but a certain number committed. It's publicly filed now. You can look at Form D and see what the initial round of the SAFT was. SAFT is the agreement that they used to sell these tokens to accredited investors.
What does SAFT stand for, and kind of how did it come about?
So the SAFT is a way to sell to accredited investors in finding a groove in securities laws where what you're doing is you're selling essentially tokens to people, blockchain tokens, but they don't get them right away. So the SAFT stands for a simple agreement for future tokens, and it's designed like a forward contract. So the investors pay money now, and with that money, you expend efforts to bring them value. So you build this blockchain network for them. And when the network is developed and finished, then they get the tokens. And so it's kind of an elegant, simple commodities forward contract that is designed to be a security, because the funds that are coming in, the investors they're taking a risk that they're not going to get anything. It's potentially going to be the case that the funds will go to no use. That people will take the money and go to, what I said to you guys earlier, like fly to Dubai and just have a fun little week and spend $50 million, right? That could happen. So the investors are putting up risk capital, and as the reward for putting up that risk capital, they get these tokens, and that economics, where the money's put up at risk, is what gives you good arguments that the SAFT is actually a security. And so because you're selling a security, you have to do you have to find an exemption under securities laws, or you have to register with the SEC. And so what Filecoin did is they sought an exemption. So the exemption that they got was under Regulation D, which is a way to sell to accredited investors, raise as much money as you want, sell to as many people as you want, but not have to register with the SEC, like you're not going public.
So can you just speak to what an accredited investor is and kind of who can get involved? So the Filecoin sale, they raised $250 million, but it was only to accredited investors as opposed to non-accredited.
Yeah, I mean, does someone else want to cover the accredited standard?
Yeah, I can talk about it. So generally for individuals, it's $200,000 in income for the previous 2 years and reasonable expectation to have it for the next year, or $300,000 joint with your spouse. There's also a net worth element of $1 million, and there's specifics in there as far as how you value your home and that kind of thing. But generally, think about $200,000 to $300,000 in income or $1 million of net worth, and that's kind of the target. And I guess maybe circling back a little bit of sort of why this all came up. So when you're thinking about doing a token sale, the big issue came out as to whether these tokens actually constitute a security. And under securities laws, if you issue a security, you either have to register it or you have to put it under an exemption. And so when you look at what is a security, these tokens don't really fit well into the definition. It's a very long definition under securities laws that includes things like stock in a company or a note, evidence of indebtedness. There is one term that says investment contract. And so that is what seems could be relevant when you're looking at assigning tokens. And so a lot of what we do as lawyers in this space, in the security law analysis, is are these tokens investment contracts? And the more that they look like investment contracts, the more it looks like a security, and then you either have to register your token with the SEC or fit under an exemption. The SAFT, as Josh was saying, came about because, and we might get more into the test on how to figure out if something's an investment contract, but generally, if you're selling a token before the network is actually live and built, and the token holders can actually make consumptive use of it, it starts to look more like it might be an investment contract. And so the SAFT model allows a company to raise that early fund to build out the network and do it in a way that complies with U.S. securities.
So with respect to the SAFT and only being sold to accredited investors, there are some people in the market who aren't accredited investors that maybe did really well with Bitcoin, Ethereum, something potentially not classified as a security, yet they wouldn't really have the opportunity to invest in a SAFT type financial instrument. So it's being said that that can affect decentralization, as a significant portion of the tokens are essentially centralized to wealthier people. So my question is, and I don't think there's an answer for it at the moment, perhaps in an order of magnitude, what is the ideal amount of future tokens to sell in a SAFT such that you could still maintain a level of decentralization amongst non-accredited investors when they do become tokens?
I mean, the fact that like a limited number of people get tokens at the outset could lead to that conclusion, right? You could think, oh, it's in the hands of the few. What happens in practice, so this is more business side of it than the legal side, there's a lot of strategic partnerships that get formed among the earliest people who invest in your platform, the people who help you out early on. Sometimes there's agreements to lock up the tokens for a certain period of time so that you're not flooding the market. Sometimes there's vesting so that when and this is what Filecoin did. So there's a linear vesting so that when you commit yourself to holding on to the tokens for 3 years, and that's a form of making sure that the interests of the investors, even though it's fewer than the world, the interests of the investors align with the overall interests of the company that's developing the network, because they also want to see the success of the network. Every decentralized network lives and dies by network effect. So Facebook lives and dies by its network effect. It's true that you need the more broad and widespread the distribution of and use of the tokens are, the more secure the network tends to be. And so if you're an investor and you care about the network, and you have provisions and contracts that force you to care about the network, then you want it to reach that point. You want it to get to that point where it is fully, truly decentralized. And you do, and a lot of these strategic partnerships are people who have YouTube channels who do reviews of tokens, people who are what's it called, like PR specialists also that offer partnerships. There's technical advisors, code auditors that provide essential support to really build, in some ways, hype, but also trust that the token is the thing that's worth supporting and the ecosystem is worth supporting. So all those things exist when you have even, not all the time, right? But they can exist when you have the funds go to only investors.
So then on that note, is it, and I think Nick would be able to speak a little bit better to this. So in the startup community, we previously saw, before these token sales, you'd have to reach milestones to get funding. And now we're seeing startups essentially raise $100 million kind of from the crowd. So what is this potentially doing to the VC world? Is it that you only want to accept money from very high-level VCs because otherwise, you don't have to take those meetings and do those confidentiality agreements when you can just offer it to planet Earth through Ethereum? So are we seeing kind of the end of a lower-level VC? Is there consolidation in that market?
So I think there's a lot remains to be seen. Certainly, this idea of how startups and VCs are looking at this space is interesting to me, and it's sort of started my firm to work with startups and VCs, and that's what I've been doing for several years. And it's interesting to compare sort of the principles that you learn as an entrepreneur on how to raise money and what's happening in the token space. So things like you said, in the non-crypto space, to raise funding, you build traction first. In the crypto space, you write a white paper. In the regular space, you raise money over time, little by little, as you hit milestones. In the crypto space, you raise a ton of money right away, and even when you look at liquidity in the normal startup space, it's 5 to 7 years. Now it's 5 to 7 months with crypto. And so there's a lot of things that are being turned on its head when you go about as an entrepreneur looking to raise money. From the VC side, I think a lot of VCs are trying to figure out how to play in this game, right? And it's difficult. There's so many angles to look at it from a VC standpoint. So for some companies, it almost doesn't even make sense to invest in equity anymore, right? Getting the tokens make more sense. But can your VC fund invest in tokens? Are you allowed under your LP agreements to do that? How do you value companies that are issuing tokens? I mean, we're seeing very outsized valuations for these token sales. And so there's a lot of questions. We're so early in the space, and I think maybe a theme that you'll see tonight is that there's a lot of uncertainty right now. There's a lot of unpredictability. We're really in the early stages of this. And so a lot of market players are really working hard to figure it out. VCs, certainly hedge funds, which Kevin, I think, can speak to a bit. They're also probably a little excited that they can play in the startup world and gain liquidity. But yeah, there's a lot of interesting stuff happening across the investor landscape.
Yeah, I'm an investment management lawyer, and we've been getting inquiries from time to time from asset managers how I can access these assets, or can I build a fund specifically to invest in these assets. And I think, like Nick said, I think a lot of the existing fund documents don't talk about tokens or companies that are generating tokens. So they're probably, unless they can go back to the investors and get an amendment and consent to invest in something new, they probably start a new fund. But I think the performance has been remarkable in this space, in these tokens. And I think the three ways asset managers have been looking at it is, can I invest in the token itself? Do I invest in the company through a SAFT, or do I take equity in the company that's generating the token? And I think the SAFT and the equity investment in the company are clearly securities. The token, and maybe this goes back to the first point, it's just, I think there's still a lot of gray areas. These tokens and the digital currencies are sort of a combination of a commodity, currency, security, and a payment system, and they don't fit neatly within regulatory net. Some of these statutes were drafted in 1940 and earlier, and we, representing fund managers, up till a few years ago, we didn't know, the SEC had clarified whether fund managers had to self-custody subscription agreements when they invested in another fund, or whether they had to hold that with their custodian. So there was, that's how far behind I think the regulatory apparatus is, and how much development there needs to be. But I think going back to the initial question, when is a token a security? And we can certainly talk about that, but I think that's essential when you figure out how you're going to invest in these assets. Are they securities? Are they not? And get your sort of regulatory requirements will vary depending on the position you take.
So let's stay on the hedge fund point for a moment here. So I'm not sure if you guys have seen the recent Bloomberg interview with Mike Novogratz. He's a billionaire that's really investing a lot in the cryptocurrency space, and he's it's speculated that he's getting ready to launch a fund of approximately $500 million. So on that, Kevin, if you could speak to what custodianship is, potential exceptions to that, you know, and whether or not there is potential, you know, the panel, feel free.
Yeah.
Is there liquidity to handle a fund that's worth $500 million?
Yeah, I'll speak to the regulatory considerations about having a fund that large, and I'll defer to the other panelists on the liquidity point. But you know, so ultimately, if you create a fund and you're going to invest in things that are securities, so maybe he's going to do, we don't know what he's going to do in it. You know, he hasn't really been very public, and he can't be because he's doing a private offering about what he's investing in. But say he's more than half his fund is you know, securities, and he has tokens on the side. Well, he's going to have to register as an investment advisor, presumably, unless he's doing this from outside the U.S. And you know, running a fund as a registered investment advisor, then you need to comply with what we call the custody rule, which requires basically a national bank hold every security, you know, or the assets in your account, in your fund. Now, you know, I think that's been something we've wrestled with. I don't think there's an answer. You know, I don't think there's custodians out there that are willing to custody tokens at this point. And you know, the rule requires you to keep it with an FDIC insured bank or a savings association, a broker dealer that's registered. You know, so you know, that's something that the industry will solve over time. But I think that's one issue. I think, you know, especially with respect to European asset managers developing European funds, you know, we've heard that it's the AML rules in Europe are very strict, and it's difficult to, you know, you can get a bank account for the fund, you can take in the cash and buy the coins, but getting the coins back to fiat currency to then pay out to the investors, the banks are having difficulty, you know, because they can't track the source of funds, and so they can't fully comply with the AML rules. So that's another thing that the industry has to solve for. But you know, a $500 million fund that it's a securities pool, you know, will be, you know, there'll be some issues to navigate.
I think just jumping in on the liquidity point, obviously that's a kind of a commercial / business point rather than necessarily a legal point, but I think it does go to how the exchanges are regulated. You know, obviously you can have, presumably if you've got $500 million worth of Bitcoin, you're probably going to do that off exchange, you're going to do an OTC, an over-the-counter trade, and so the price mightn't necessarily reflect what's on exchanges, but oftentimes exchanges and the prices that exchanges discover is what's kind of used as a reference point. And up to now, certainly in the US, I mean, Kevin, I think, mentioned it, you kind of got, if you were to spin the regulatory roundabout, you've got payments law, you've got securities law, and then you've got commodities potentially. And I think at the moment, you know, when Bitcoin first came to the scene, the exchanges were regulated as money service businesses, and were regulated really with anti-money laundering and know your customer requirements as their main focus. So Coinbase, for example, had to register in 50 different states as a money service business, or you know, the comparable regulation for each individual state. When really now, I think Bitcoin and the other major cryptocurrencies have reached a scale in terms of their market that they really need some market-based regulation, which I think the SEC has to some extent, and also the CFTC has experience in regulating markets, in dealing with things like spoofing, wash trading, and other abuses that currently don't have any sanction as it stands, unless Coinbase or GDAX or whoever the exchange is decides to put them in its rulebook.
And does that play OTC? OTC means over-the-counter, not necessarily going through Coinbase or Gemini, Bittrex, Poloniex, or is that an exchange issue?
I would say it's an OTC, and I'll explain why. I think, so last week there was an event that I think kind of flew under the radar, and just to take a step back, I'm generally a derivative / commodity lawyer. So commodities fall under the purview of the CFTC, the Commodity Futures Trading Commission. You'll notice there I said Commodities Futures Trading Commission. They generally do not have oversight over the direct commodity market, the spot market of Bitcoin. However, in 2011, in the Dodd-Frank Act, the CFTC was given the power to take action potentially in a spot market against market manipulation and false information. So last week they issued what seemed to be a pretty straightforward action, but they took it, and it was the first time they've ever taken that action as it relates to the Bitcoin spot market against a pretty and alleged Ponzi scheme. Now that's not particularly groundbreaking, but that's the first use of their power in the Bitcoin spot market. So
This is the CFTC?
This is the CFTC. I don't think, so they have the power to regulate a spot market. In general and in practice, they'll only do so if it affects the futures market on which that commodity relies. But there's nothing legally stopping them, and they do have the power to regulate that market. So if somebody in the OTC market was taking some action that had an impact on exchange prices or just the spot market generally, then the CFTC would be capable of taking action.
So we're seeing now a lot of hedge funds pop up all over the world, between $5 to $100 million. Again, speaking to liquidity, and it's potentially $500 million hedge fund, but the majority of the trading happens off exchanges. But it's likely that the prices are dictated by exchanges, and the exchanges, I don't think, handle, over the counter. I think this is speculation here, but OTC is about anywhere from between 100 million to several billion dollars per day, whereas Bittrex and Poloniex is orders of magnitude less than that. So we're potentially seeing prices dictated by smaller amounts of trading, whereas the greater trading is on OTC. And I think that plays because what if one of these hedge funds put in, we saw it on GDAX, someone put, was it $10 million sell order on Ethereum, maybe it was 30 million, and immediately crashed the price. But that happens on the OTC on a regular basis, on a daily basis. So if we have now one of these hedge funds that decides to put in a $20 or $30 million sell order on Bittrex, the price of Bitcoin could just crash immediately. And now that these are kind of happening everywhere, especially if we're going to have potentially a $500 million fund come up, do we really have the liquidity for this? Is this, and again, this is more of a business commercial point as opposed to law, but is this potentially not the best thing for the ecosystem at this point?
I'll talk a bit about this. So how much volume was there today? Like billion and a half?
1.8.
Yeah. So there's 500 million, 1.8 billion a day. It's growing every day. I think it's fine. The exchange question is interesting, though. I like regulatory roundabout.
Yeah, I think people are regulatory student roundabout. I think Snoop, probably don't know.
Bros stuff. I don't know, man. I'm trying to follow. So the regulatory soup roundabout is interesting because exchanges, you spin it and you land on the payments piece. And that is governed by Financial Crimes Enforcement Network. And what that says is if you're accepting and transmitting funds on behalf of other people, funds can mean cryptocurrency. Then you're a money transmitter. And that's such a broad definition. I mean, think about how often you, you borrow money from people, or you go out and you split a bill. You take money and then, you take their money now and then you give it to the waiter, right? Like you're accepting funds and you're transmitting it to someone else on behalf of someone. It's such a broad definition. It's crazy. So exchanges clearly fall under the definition of accepting funds. They take custody of crypto, and then they hold it in their wallets, and then they transmit it on behalf of their customers. Some exchanges have non-custodial wallets. For instance, like Shapeshift is an example where you don't actually give your funds to Shapeshift. They have a separate system in order to sell you different versions of crypto. So, but my point in landing here is, this is just one small slice of the wheel, where you have Financial Crimes Enforcement Network, which is worried about, think about the name, financial crimes. It's worried about money laundering, and it's worried about funding terrorists. Now, if you think about that as a driving force of a regulatory agency, it's not going to cover all the things that you mentioned, like wash trading, like spoofing. Like they're not going to care as much about things that kind of matter to the industry. So you have to turn the wheel a bit get to whether or not the SEC governs the exchanges. Well, the SEC is the Securities Exchange Commission. So if they're not selling securities, then what jurisdiction would the SEC have? So you spin the wheel again, and you get to the CFTC. And generally speaking, you know, these things are considered commodities. But as you pointed out, the CFTC doesn't really doesn't really exercise a heavy hand with its enforcement over, even though it has the authority to, over the exchanges. So, I mean, there were some actions for some margin lending that was going on in the exchanges. But the spot commodity transactions, which is the majority of what happens on these exchanges.
Can you speak to what does that mean, spot commodity?
So a spot would just be the direct trade. So if I traded a Bitcoin with Josh right now, if we agree tomorrow that we're going to pay, that basically he'll take the risk of what the price is tomorrow, that would be likely a forward, and that would be a derivative, would be a contract that is based on an underlying asset, and that would be the derivative market. The spot is trading directly and trading on the same day. So there isn't really much of a derivatives market at the moment for Bitcoin or cryptocurrency. Ledger X and Terra Exchange are two entities that have sought regulation and recently got regulation. Ledger X, which I believe is due to launch on October 12th, has probably the most boring derivative I've ever heard of, which is a day-ahead Bitcoin swap. So it is a single day in advance. It also, the regulatory status of Ledger X, when it received its the appropriate registration from the CFTC, to get around a lot of the requirements that, you know, relating to data reporting and custody of assets and a whole host of other things that normally apply in the derivatives market. It essentially mandated that every swap had to be 100% collateralized, so you're putting the money up front for delivery tomorrow. So, I mean, if you're an ordinary Bitcoin user, there's just no point really in doing that, frankly. But I could see the value to an institutional exchange, for example, with a swaps trading desk, which knows what a swap looks like and knows and can trade it, and can use that. And it also gives the CFTC a bit of an in and a bit of an argument to say, listen, there is a derivatives market overlying this commodity, so, you know, maybe we should put in place some regulations.
Yeah, and going back to the liquidity point, I mean, you know, when we look at building out funds and we want to do a small client wants to do a small cap fund, we always ask them, you know, how scalable is this? What's the max size of the fund before you're going to close it? Because, you know, soon it can take you too many big positions. You'll be chasing your own position and moving the price. So you know, with a $500 million fund, I think hopefully the same analysis was gone through, and you know, hopefully, you know, they'll be dribbling in his cash into the market. Otherwise, the prices will spike. And you know, I think if you try to, you know, redeem too many of those positions too quickly, you'll either, you know, you have a liquidity event with respect to the market, or the prices will drop, or both. And you know, it'd be like a situation where 2008, where you have to shut down the redemption ability of the fund. And so hopefully the infrastructure of funds that large are built in a way to create mechanisms to, you know, maybe it's only quarterly or semi-annual liquidity above a certain percentage of the funds NAV that's redeemed at the gate. But you know, those would be, you know, things you'd want to think about.
I think you really just scared everybody by talking about 2008. Nick, you have a comment?
Yeah, I'll just say too, like, there's been a lot of talk about exchanges. So for all you out there who are thinking about doing token sales, the companies themselves have to think about a lot of these laws, right? So FINCEN, the Financial Enforcement Crimes Network, that applies to companies who are issuing tokens too, potentially. And you know, obviously we talked about securities laws, those apply. So all these things too, although we sort of framed it in the context of an exchange, you really need to be thinking about these from the standpoint of potentially doing a token sale of yourself.
And that's really important, because what we're seeing now, so since the SEC Dow report, in which they said what Slockit was offering was in fact a security, but just kind of imagine the repercussions of that. You know, so Slockit was able to amazingly raise $150 million for an unregistered security. Imagine it listed on Poloniex or Bittrex. Did it ever list on Poloniex or Bittrex?
sure it ever got to the...
I don't think it is. So imagine it listed and then the SEC comes out with this report and then essentially shuts it down, immediately destroys the liquidity. You probably have funds that are frozen, and what happens to the cryptocurrency? It just kind of is in limbo until it can be figured out. So that's why it's really important to, if you're planning on doing a token sale, kind of get a hold on this. And specifically, since the SEC DAO report came out, I don't think Bittrex has listed the token, and it's been about 2 or 3 months. And Poloniex has only listed, I think, about less than 3 of them. And there's speculation as to why this is happening. But a lot of it is, you know, yes, we're in the wild, wild west, but the regulators are watching. So, you know, definitely be careful and listen to our friends up here. But, so, do you guys have any insight as to why the exchanges are not listing tokens? And how will decentralized exchanges play with respect to that in the future?
I think one kind of potentially underappreciated point of the SEC's report about the DAO was, if you read it closely, it uses 2 terms. It uses virtual currency, and then it uses a virtual token or coin. And the SEC issued its investigative report, and then it also issued an investor alert at the same time. And the risks it associated and it outlined in that investor report related to virtual coins and virtual tokens. And it referred to Ether and I think Bitcoin as virtual currencies. Now, that's an investigative report. That's not necessarily a determination, a definitive determination that you can 100% rely on from the SEC, but I think it gives an insight into how they view and where they draw the lines. So I think on the one hand, you've got Ether, which they consider a virtual currency, if that's distinct from a virtual coin or a token. And then you've got the DAO, which is a virtual token or coin, and that's a security. That's obviously a very large, spectrum, but it is 2, markers in the sand, I think. So I think that is at least helpful that the SEC report included that element.
So let's take a step further. So what did you call it, a regulatory soup wheel?
I'll go with a regulatory roundabout, just for the
regulatory roundabout with a little soup on the side.
You're not used to roundabouts here, but they're overrated in Europe.
So why don't we get into that in Europe? So the U.S. has taken somewhat of a hands-off approach to it, but most of the action happens in Japan, South Korea. For whatever reason, it's not talked about too much. South Korea, I think now, is allegedly about half of the world's trading in cryptocurrency, and is the #1 volume, 24-hour volume for Ethereum in the world. How important is it, if you're planning to do a token sale, to get counsel, co-counsel in Singapore, South Korea, Japan? Or is it that the U.S. securities law is such a high bar that a handful of disclaimers for those countries may be okay? Sorry for putting you guys on the spot.
Yeah, I mean, from my perspective, I've always